Welcome to Surgeon Syndicate. If you're paying attention, you know that you only make money when you work. It might be great money, but it's dependent on you. The information on this podcast will help you solve that. We interview experts and provide analysis into financial freedom through commercial real estate. Why? To help physicians like you thrive. Let's dive in.
Welcome to Surgeon Syndicate. This is your host, Dr. Michael McManus. Today, we're here to do a retail review. And for me, I get to do it for the second time today. One of my biggest fears in recording this podcast is that I never hit record. And, some of the new AI features in Zoom where we're recording these, they're great for generating content later on, but it makes recording a 2 or 3 click process. And I didn't go through all my clicks. I'm recording podcasts with an interviewee. I'm always double checking, and I have the screen up where I can double check that. So luckily, I've never done that with an interviewee. But today, reviewing my notes, I was looking at the notes and not at the Zoom screen, and realized I just did a whole show and didn't record it. So we're back, and the second time is going to be even better because I already got some practice at it. So today we're talking about retail trends as related to commercial real estate and the retail market in general, because where retailers go, retail real estate follows. So what trends are we seeing today? We're seeing a move into shopping centers of grocers, gyms, restaurants, and other retail merchants. Why is this happening? Well, construction is slowing and retail rents have been continuously moving upwards. And where did we used to see most of the vacancies? In the mall. I mean, hats off to the people running some of the big malls and these big mall companies. Because really in the last 5 years, as I've been watching malls and wondering about what's going to happen to them, I've seen a lot of malls that really were struggling, being reborn, and or ones that have seen some of the bigger spaces close, and they filled them with new things. They've divided them up. And so the mall managers are really doing a great job. Some of the tenants we're seeing moving into suburban and open air malls are gyms like Fusion Gyms, and moving into a space that was once a Macy's, and grocery stores like Sprouts Farmers Market and Trader Joe's have also been announcing mall locations. Who's not doing so well are outlets. So the outlet industry is valued about $65 billion. These are the places where people seek their favorite brands at a good value. However, during the pandemic, e-commerce giants like Amazon and high inflation hurt the industry, which struggled to recover compared to some of the other indoor and open air shopping centers. A lot of these value centers are off on their own. Dollar General likes to be on their own, or in more of a strip mall, which is one of my favorite categories. And this is the industry as a whole. So it's some of these retailers are doing well, where some others have struggled. The question here is, as we're starting to see some pressures in the economy, consumer spending has really kept up so far. But as people see more pressure, is this maybe a low point in the cycle for the outlet industry and some of these bargain stores that may actually see a pickup in the coming future? And is this a good investment for those who are looking to go against the tide here? I don't know yet. We'll see, but I think it's really an interesting place to be. Retail sales are holding steady. When I look at these numbers, it's so interesting as we've seen inflation and we saw a lot of easy economic policy, money printing, low interest rates over the last few years. So when we look at the U.S. retail sales in June, were stable at about $704 billion, which is up 2.3%. But if you add in inflation, that's pretty stable. Online retailers saw the biggest growth at 8.9%. Building materials and garden supplies rose 1.4%, which, just for inflation, is actually down. Same with furniture. It appears that electronics are really the strongest, one of the things that people are still buying. Is that because now instead of going out and doing other things, people are staying home and playing video games? Are people buying new technology to support working from home? Didn't find any of that information in my review, but those are some of the questions that I'm asking. As we get into, what's going on in the retail world as a whole, shoppers have been finding better deals on Prime Day, and Prime Day reached a record $14.2 billion this year. This is up 11% from last year. A lot of it driven by mobile shopping. So people shopping from their phones on the go, which is up 18.6% compared to last year. So I think more and more, where we used to sit down at the computer and shop, people are actually throughout the day just shopping and spinning through their phone and doing it from their phone. And a lot of this is where we've seen the rise in in electronics compared to last year. Electronics rose 81% on Prime Day compared to previous years. Who else is doing well? Dave's Hot Chicken is on track to reach 300 units by the end of the year. His franchise started in 2017, so they have been growing fast across the United States, Canada, and the Middle East. Fast food, also Jack in the Box, growing and returning to Chicagoland for the first time in 40 years. So in an area where a lot of people have been pulling out, Jack in the Box is moving in and appear to be on the uptick. The Olive Garden parent, Darden Restaurants, is buying Chewy's Tex-Mex. This adds some new brands such as Longhorn Steakhouse. Alongside Olive Garden and Longhorn Steakhouse, they're adding Chewy's Tex-Mex. So the eating out industry appears to be doing very well, as that trend of people eating out rather than cooking at home tends to be looks like it's very stable and growing. We get to the retail and department store or multi-good stores. Macy's had been in takeover talks with Arc House Management and Brigade Capital Management for several months, but they've broken these off and have decided to not go through with that takeover and are now going to focus on what they call their bold new chapter strategy, which involves closing 150 stores, expanding their small format stores, and increasing their staff to improve customer service and monetizing assets. Target is continuing to grow. They're on a trajectory to open 300 new stores across the country, and also increasing in-store services like CVS and Starbucks, which appear to be in almost every Target by now. Whole Foods is rethinking their real estate strategy. They're saying where they're tailoring stores more to local communities with customized architecture and product offerings. My impression always been Whole Foods are always in pretty similar communities in most places, but they're even deep diving into this even more so, trying to offer things that those specific communities are looking for. A lot of these are urban markets, as people are moving into revitalized cities is one of the places where Whole Foods is making their push. So in bigger economic news, U.S. job growth has slowed this month. Economy added 206,000 jobs, down from 218,000 last month. The unemployment rate rose to 4.1% compared to May's 4%. Now, to me, these are very small numbers, but for those who are always looking to jump on the let's talk about interest rate decreases, there are analysts out there saying this could support the Federal Reserve having interest rate cuts potentially in September. This is one that I've talked about it before. Really, when you look at 50-year averages, we are back to normal interest rates after 20 plus years of artificially low interest rates. What those low interest rates have done is driven a lot of asset appreciation, which has helped those of us in the upper socioeconomic classes, but hurt a lot of those lower down. And we'll talk about this a little bit more later on. But everybody loves to see cuts in interest rates. And so a lot of people love to talk about it. I don't think we're seeing anything substantial soon. And this is for two reasons. One, the biggest one is we're kind of back to normal interest rates. But the also one is there's a lot of things that could be potential headwinds in the economy. Going forward, the economy is doing fine. And interest, if when the government has no room or the Fed has no room to cut rates, they lose one of their biggest tools. And right now they've got some dry powder. They've got some stuff they can use there, and they don't want to give that up. So we'll see how that goes. But I don't think we're going to see any big changes in interest rates. With interest rates staying higher longer than a lot expected, and this supports the viewpoint that I hold that interest rates aren't likely to dive down recently, is we're seeing those who hold commercial mortgage-backed securities cashing out on their gains. Sorry, not those who hold the securities, but those who have financed through them. So sales of buildings with maturing CMBS loans are increasing due to high interest rates. In 2021, only 3.8% of commercial sales over $2 million involved CMBS loans maturing within a year. This has now risen to 5.6% recently. And on properties over $15 million, it's risen from 4.9% to 7.4%, adding $11 billion in sales. I think we see this in these higher number in properties at higher dollar volumes because they require different types of financing. That's where we get into the mortgage-backed securities. But this trend to sell has been driven by higher interest rates, making refinancing expensive and leading owners to sell properties and cash out some of their positive equity situations. The question will be, is this kind of continues if there's more sales? Because right now we've seen willing buyers at the prices where we're at. But as we see more sales, will this put downward pressure? And in some of these situations that have been talked about with, as we see more and more commercial loans coming due that are to be refinanced, are going to have to be refinanced significantly higher rates. So these are the ones that were properties that were bought at 3 and 4%. As these come due and refinancing at current rates can turn the cash flow upside down on a lot of properties. So a lot of properties are expected to come to market. There may be more selling pressure. I think we're looking at, a world where cash is king, and there's going to be some good deals coming on the horizon if this trend continues. I saw an interesting article that talked about fast food inflation, and it was really just a chart that was an attention grabber and wasn't really an article that gave any background, but it showed that price increase over the last 10 years. So McDonald's was the highest, 100% increase in the last 10 years. The other big ones were Popeyes at 86, Taco Bell at 81%, Chipotle at 75%, Jimmy John's at 62%. Most were at 55%. That would include Wendy's, Arby's, Chick-fil-A, and Burger King, and Panera came in at 54%. So we're seeing this fast food inflation. So where is this coming from? And really, is there a bigger perspective on this? When everybody talks about inflation really over the last 5 years, because that's when everybody has seen it. So when we look back at that 100% on the items that they chose, as I was doing a little research, found that some items in the McDonald's menu, like the McDouble, the McChicken, and the medium fries, have actually gone up nearly 200% in that time frame. But their increase in the inflation rate over the same time period has been 31%. So they're much above that. And pretty much all of the fast food chains have been much above that. Looking back to the last 5 years when we've talked more about inflation, McDonald's prices have just gone up 22%, which is aligned much more closely with the overall inflation rate. So actually, most of those gains came in the first 5 years, which is interesting because during that time frame, we didn't talk a whole lot about inflation, but we have since. So it's been slower. When we talk about who eats fast food, I think everybody eats fast food across our society. But typically those in lower socioeconomic groups eat more of these fast food compared to other socioeconomic groups. And so here I was, I was doing a little research and doing a little digging, and some of this because I find it's easier to kind of get a broad overview using some of the AI large language models versus just Google searches now, because you get a lot more information compiled together. And really kind of what have we seen when we look at these different socioeconomic groups and what impact has inflation had? And so in looking at this, the interesting thing here is you start playing with Chat GPT and some of these other large language models. And what they do is they've really been trained on everything that's out there. So the more that's written about something, the more they will refer to that as being the authority. They also look at things that it has been programmed to consider certain websites, certain resources to be more reliable. And they give the most reliable, the highest category to government websites and then academic websites as being non-biased. Well, this also builds in its own bias. But interesting things as I went through this research with both AI and on the internet, but really in looking at what's happened with inflation is, when you look at inflation and its impact of cost of living as a increase as percentage of gross income, by far the biggest impact has been in the lower third. We've seen the same type of effect on middle incomes, but it hasn't had as big of an effect on their cost of living as a percentage of gross income. Now, when you look at higher income households, most of them have actually seen more increase in income than they have seen in cost of living, and in the top 5%, even more so. Why is this? Well, when you've got stimulative economic conditions with low interest rates, that is where those who understand how to use leverage to make money will make more money. Low interest rates drive up asset prices, which drive up both income and net worth of the highest income individuals, and actually punish the low income. And so I in trying to do this research, I get in this conversation, and this is just kind of a little bit of discussion here at the end about how AI works and how this is going to affect us going forward. Because, remember when Google was new, so 20 years ago, you could go on Google and you could find this great variety of opinions and information. And you could, if you wanted to go find alternative viewpoints, it was really easy. Well, the way those are built is they want to show you things that everybody else is looking at and things that you've looked at before, because this is what you're interested in. So and the whole idea is that, if I'm somebody who's, loves fashion, when I go and I search for something, it shows me the fashion I want to see. And it's not showing me, something about something unrelated. But what it does when you get into the bigger thought processes is it starts to show you the same thing. So it drives kind of a group think where you get whole groups seeing the same thing over and over and really feeling like that's the truth. And even within our own minds, it self-supports what we're thinking, and we tend to challenge ourselves less because it just feels like, well, this is what I see all the time, so it must be right. Well, AI, a year and a half ago, 2 years ago, when this was all new, it really gave you these much more diverse viewpoints. And it was fun to play with because it would churn out these ideas that you're like, that's very interesting. That's very different. Where now what I see is it really is more kind of much quicker, has followed that same path as the search engines of really drilling down and giving one viewpoint. And it even, Chat GPT seems to like even less and less to go out of that framework. So as I'm playing with it, I'm trying to get some more information, because it's consolidating all this stuff on the impact of what's happening on different socioeconomic classes. Why am I doing this? Because we're heading into an election season. We hear a lot of political pundits talking about how their thing is going to be better. And I think a lot of it is pandering. And when we talk about a lot of economic policies that are supposed to help people, like during COVID, we printed $11 trillion, and this was helping people who were vulnerable and poor, and they were just writing them checks. Well, what's happened in the end is what we've seen is it's driven inflation, and inflation has hurt those at the bottom more than at the top. And if you divide instead of thirds into quintiles, it's hit the bottom 20% the most, the next one, the next most, the next one, the next most. And as you get into the top tiers, they've actually benefited from it. And so it's it's an interesting thing. So as I'm digging into this and I'm asking, these questions and trying to get a different perspective on it, I start to get the same thing. And at one point, I asked, ChatGPT kind of goes in and gives me for each quintile, and they break it down. They just call it cost of living, disposable income, and interest rates, and talk about how it affected each one. And then kind of give a general overview, but it didn't really dig into comparing which ones got benefited or hurt the most. So I asked it to go back and look at the benefits of those with more disposable income and net worth, and how it drove up their net worth and how it hurt the other people because the policies caused inflation. And initially, it kind of did the same thing again. So I pressed it again and said, okay, I understand your argument, but I want to compare these in a bigger sense. And then it jumped off into this whole other realm where it went out of its instructions, and it wanted to talk about all these other political policies, and really started going down this one road. So I was asking it to challenge itself and go find some other sources that challenge this and give a different perspective and refute your claims. And ChatGPT used to do this pretty well. It would go out and would find stuff, and it would come back and refute it. But now it didn't. And it might be that in my prompting, but it kind of held the party line. And when I kind of asked it, it looks like you're being biased. Why do you keep giving me the same answers? And this was interesting because then it, and I'm trying to find some different answers from the political standpoint because we're heading into a political season. And what it told me, though, is where it told me where its sources came from, and that it prioritized government reports the most and then academic reports. And so for any other people outside of those worlds, which is like the people really driving the economy and driving change, it didn't want to go to those sources because it considered those sources not as reliable, and that those sources were more biased. And so at least at this point, it might have been my prompts. And then I got in a little bit of a hurry because I was getting ready to go on a different podcast, and I had to close it up. But I think the whole point of this is, as we move forward as a society, one of the things that I'm seeing, and I think we'll see more of with AI, where in some cases AI can be a great way to generate new ideas and promote thought. But in most of what it's being used for, that I see it being used for, it's more driving people into one thought process. And so what people used to call, corporate groupthink, I think we're seeing more of, and we're going to, and I really think, and we'll see, that we're going to see more people having the same idea and the same perspective. And it's just really going to give a lot of opportunity for anybody who can think outside of the box or find a way to, become a better prompter to get ideas outside of the box and alternative opinions. Because I really enjoyed ChatGPT in the beginning, and to get it to give me different ideas and have little arguments with it, but it seems much less willing to do that now. So, big point there is a lot of what we're going to read is going to tell us one story, and everybody's going to be heading in the same direction. And from an investing standpoint, a real estate standpoint, as Warren Buffett says, the time to be greedy is when other people are afraid, and the time to be afraid is when other people are greedy. So I hope we've added some value today, and I thank you for listening. And if you have any questions or want to discuss this further, please reach out. You can book a call on surgeonsyndicate.com, and we can, like I said, I'd love to have these conversations with divergent thought here. I'm excited about retail. I think there's a lot of great things happening, and because there hasn't been enough new retail being built, there's a lot of pent up demand, even though there's still a lot of online shopping going on. There's a lot of things that can't happen online. We're starting to see some good things happening in retail. We've got some opportunities through Fortress Capital now that we haven't seen for the last over a year. And so anybody who's interested in jumping in, got some real safe stuff right now, some cool triple net leases from superior national credit tenants that I'm really excited about. So if you'd like to talk more, again, reach out at surgeonsyndicate.com, book a call. Let's have a conversation. And for everybody else, thank you so much for joining us here on Surgeon Syndicate. Join us next time.
This has been an episode of Surgeon Syndicate. If you got value from this episode, you know other surgeons are hungry to become job optional, and you can help them by sharing this content today. Schedule a call and we can make a plan. Looking forward to having you with me on the next episode.